Why do spread betting providers require a margin payment? It has probably happened to you more than a couple of times that as a result of taking a bet from a friend or a co-mate, you end up being owed an expensive bottle of champagne only to never receiving your due. This is cited to as credit risk in banking terms. If an investor buys a leveraged position with a spread betting provider, it can only result in three possible outcomes. Outcome 1. Both parties owe no cash. You are happy, the broker is happy. Outcome 2. The broker owes you money. Of course you are happy. The broker, not so happy. Outcome 3. You owe the broker. You are unhappy, but do you have the cash at close hand to pay the difference? The broker is unhappy as it now has effectively lent you money without even knowing whether you are able to honor your liabilities and may need to resort to court proceedings to recover payment of its debt. Spread betting, margin workings. Now this problem is solved by the spread betting provider requiring a margin payment from every investor that wishes to take a spread betting position. The margin is there to protect the spread betting firm from the risk that a trader might incur losses that he or she can't pay back. The risk management from the provider's point of view is determining what the margin rate should be for the market under consideration. Now, there would be little basis for requiring a trader to deposit a full 100% margin for the underlying financial instrument, as the investor would then be better off buying the shares outright via normal share dealing, and of course they wouldn't incur the daily financing charges. But of course, a 0% margin isn't possible, as the spread betting firm would then have no protection. The correct answer would be somewhere in between, the margin rate being determined mainly by the liquidity and volatility of the financial instrument. Generally, for blue chip stocks, that is, stocks quoted on main indices such as the FTSE 100, Dow Jones, etc., margin rates can be 10% or less. If your bet is making a loss and it threatens to exceed your margin deposit, the company will contact you and demand you increase it, known as a margin call. Otherwise, the provider might close out a few of your positions to ensure that you remain within your margin requirements. This logically requires the broker to have a good trading platform with a solid infrastructure in order to control this hidden credit risk. For more information, visit www.financial-spread-betting.com.